Chief Economist at Nasdaq, Brian Joyce, Managing Director on the Nasdaq Market Intelligence Desk, Sandip Bhagat, Chief Investment Officer at Whitter Trust, and Steven Wieting, Chief Economist and Chief Investment Strategist at Citi Wealth. And we're here to discuss why a balanced perspective and being prepared is a strategic approach to manage what's shaping the market today. It is great to have everyone back with us. Welcome back to you all. And Steven, I wanted to attack this panel from a more forward-looking approach, because we will get over this hump at some point.
Ideally, yes, indeed. And how big is this tariff hit? We have seen markets that can't think about deregulation, taxes, and tariffs all at the same time. So we go, from one to the other, all of the good stuff before the year began, now the tariff stuff. I think if you would look at what was announced on the headlines, and the headlines are changing. Think about 25% tariffs on Canada, Mexico, excluding some products. That's larger than reciprocal tariffs around the world. The Trade Policy Uncertainty Index at an all-time high. I do think you are going to see business confidence and business activity start to fade in line with consumer confidence, but that's what this uncertainty hit is clearly apparent in markets. And whether it's really over or not, you think you have a lot of apprehension with an April 2nd date, right, for reciprocal tariffs. And, if anything, we're moving fast. We're moving fast to price in a lot of apprehension.
Yeah. Well, Sandip, if you think about it, we know there's a pivotal shift that's happening in the U.S. economy. And rather than, waiting a year or two to see what tariff policy and policy in general is going to look like, the Band-Aid was ripped off. So we're kind of dealing with it from the jump. And there will be some type of resolution at the end of the day. How it's executed, that I don't know.
Yeah, and of all the policy initiatives, the ones that were somewhat restrictive, that being tariffs and immigration, and a reduction of government spending, those have taken flight before the extension of the tax cuts and the deregulation that are clearly pro-growth and pro-cyclical. So there is a bit of a timing mismatch here. And on the tariff front, Steve, the way I think about this, look, high universal tariffs, the best way to describe it is that they're highly and universally damaging. They're inflationary, they reduce growth, they make no sense. In fact, to the point of bordering on economic lunacy. So I do think they will eventually become selective, targeted, reciprocal. We are seeing some of that. And really, the idea is not so much to generate a new source of revenue. It is to ensure fair trade. It is to open up new markets. And I have fairly high conviction that the bulk of tariffs will eventually be much bigger than the bite. On the other side, when some of these drivers of growth kick in, there is a very important transition in the US economy from chugging along at below 2% GDP growth, which was the experience in the last economic cycle, to being above and handily above, and really for monetary policy to not matter as much as things like productivity growth, fiscal stimulus, and deregulation. So looking ahead, and even beyond a year to 5 or 10, there really is a golden age coming up of higher growth, higher cash flows, higher profits, and I'm quite bullish on the next decade.
So Phil, when you kind of separate the noise from the headlines and you look at the economic data, it doesn't appear to be as negative as the headlines may suggest.
It's been really interesting because I've been spending a lot of time on the road talking to companies, and I think the scale of the tariffs is challenging. Like, we sort of came in thinking 10% across the board, and a 10% uplift's not going to really change the world, but a 25% or 50% like we had for a day or so last week really does change the competitive dynamics of things that have supply chains. So a lot of the companies I've been talking to have been wondering where to actually spend their dollars, which I think, to your point, Steve, it's going to slow down investment, it's going to slow down hiring, it's going to be negative first. But then I bump into other companies, a lot of the companies in the US steel industry are actually kind of looking forward to some protection because they can't compete with American wages, and so the cost basis here with other countries that have sort of lower production costs. And so they're looking forward to being able to increase capacity, increase productivity, hire new people, maybe build new factories. So I think it's easy to see the negativeness of the headlines, but there are people and companies out there that are going to win. once the changes start, the supply chain changes get implemented and we start to adjust for the tariffs.
Yeah, I mean, Brian, you have to exercise a modicum of patience as well. But from a technical perspective, we can give our fundamental reasons why. What's the price action telling you?
So certainly we've blown through some levels even over the last week. So if we're looking here at the S&P 500, just a week ago yesterday we were talking about the 5784 level. That was the gap from the from the presidential election back on November 4th. We retested that in January on the initial decline, bounced off of it, and then on Wednesday last week blew through it. And in the last week we've blown through the 200-day moving average and as well as the highs from last summer. So hopefully we could see some sort of bottoming right around here. If yesterday's low is the low, that would certainly would be welcomed by many. If we do continue to roll over, we're up a little bit today, but we're actually down below from today's opening despite the CPI print, which was better. I would then look towards maybe the 5400, which is not that far down below. It's about 3% from last sale, and then potentially maybe the August low, which is around 5130. So those are the levels that I'm looking at, but definitely in the near term, 5400 from below here would be, I would think, a lot of eyes are watching.
In a market like this, where things are moving quickly, and the liquidity profile changes as well, when you don't have as much activity, perhaps as people are kind of waiting to see what happens. Do technicals matter as much, or do they matter too much when certain levels are hit?
Well, I think we're talking about a short-term time frame, so I think technicals are probably more important. They certainly matter more to different types of investors, depending on what your time frame is. And so if we're talking about a recent decline, a recent downtrend, if I'm a shorter-term investor looking to play that, I'm going to look at prior lows, moving averages, standard deviations as potential levels where I can expect an end of the correction, or a reversal of trend, and a resumption of the longer-term prior uptrend. So certainly I think technicals do matter. If we look at the Russell 2000, we can see this week it tested pretty significant breakout level at the 2000 level, which for much of 22 and the first half of 23 was resistance. And so we've now pulled back to that level. So I would think that for small caps, which have been underperformed for quite some time, maybe there you could see some reliable support.
Yeah.
Jill, the other side of the coin here, we speak about technicals. If I could take some of those price levels and connect them to PE ratios, we'll get the fundamentals into play here. We closed at 55.72. That was a PE of just about 20 times, well below the 22 and change that we had experienced, a 10% PE compression to begin with. Now, the big fear lingering out there is that, look, valuation 20 is not exactly cheap, right? And the fear is that if we were to go to the 100-year average of 16 times forward multiple, there is still a lot of pain ahead. And here, it may be worth keeping in mind that the mix of this economy is just so different. We have profitable companies where I don't think 16 is the fair PE of the US stock market. It's more like 18 and a half or 19. And so fundamentally, we are kind of getting to a point where the worst is behind us.
I just bear in mind that we've always been optimistic when the growth leaders have been really hit. Mag 7 fell 20%, but they fell to September's level. And the top 3 companies there were worth 10 trillion, worth all of the equity of either Europe or Asia. We had 3 companies worth 13% of the global equity market. So one of the things that we talked about last year, 19 percentage points of outperformance of US stocks, maybe that's okay, but 15 years of it. And we've gotten to the point now where these policies are scaring away global investors in some ways that we saw China scare away global investors in 2021. So some of the beaten down markets that have low valuations and no real growth story are getting some of the inflows. Yeah. And that's the story of Europe, really.
See, and I think that's what's interesting, because when we talk about broadening out of the market, and that would be a positive sign, and it's not just the Mag 7 that's leading the way, well, perhaps it wasn't just going to be, a market machination that was going to make that happen. It required policy and some other reasons for that to broaden out. You can't just, kind of hope that things broaden out, right? So this reset could be, from a longer term perspective, and you also noted here too, once these risks are fully recognized, once you start to get to that fever pitch, that's kind of when you take a step back with your balanced approach and let's think outside of the box.
Right. Well, just again to the point that policy is changing every day. Right. There is something more fundamental here than sort of the quick market deleveraging of August of last year. right? VIX hit 40 last year. It's 27 here, and this is fundamental in some respects. I just think that when you build a portfolio now, you're getting yield. We can build a 5.5% intermediate bond portfolio. You know, your money on the sidelines is earning something. And a global allocation is actually working, where year to date, global equities ex-US are up 7%. That's a pretty rare thing from what we've just experienced. And we should, you know, again, be saying for those of us that are really fully diversified, you know, you've actually getting the improvement in valuation and all of this that comes with, you know, the sharp de-risking in US assets.
Yeah. So Phil, what would you need to see from a data perspective that gets you a little bit worried that the economy is shifting? You know, I mean, Michael says to us all the time, 4.1, 4.2%, that going back and forth to the unemployment.
On the unemployment rate.
That's not like a concern. What do you need to see with, you know, whatever piece of data where you're like, okay.
Yeah, I mean, I think the unemployment chart scares me, but what scares me about the unemployment rate going up is if we see layoffs increasing, because layoffs are psychologically different than people coming into the workforce, which is why the unemployment rate's been going up. If we start to see layoffs, and obviously Doge is laying off government workers, and it's a pretty big spike, not material in terms of the weekly layoffs that we see just in the economy generally, but if we see flow through from that, then we all start to know someone who lost their job. We all spend a bit less in case it's us next, and then you tend to get a bit of a cycle, a feedback loop, where companies earn less money, so they look to trim, they trim people, and more people lose jobs, and you end up the unemployment rate goes up 2-3% really quickly, and we have a recession. So I am watching the layoffs data because I'm worried that that might trigger a consumer confidence collapse. And the consumer confidence is what's kept us going most of the last 2 years. It's just the spending has increased and it's kept companies growing. I mean, consumer confidence has been so important to the American story, as well as the AI part of it.
Yeah, I mean, it's been really impossible to bet against the consumer far longer than anyone had expected. Brian, one more thing, I want to take a look on the charts. We were just talking about the VIX and some historical levels there. Anything from a technical perspective that might give you additional insight?
I would just note, you know, it's common trading strategy when the VIX is above its 2 standard deviations versus its 20-day moving average, its upper Bollinger Band. When you see it close below it for 2 consecutive trading sessions in a row, a lot of times that could be, you know, a signal that maybe the fear has kind of peaked and is about to reverse. And so that would be good for equities. We saw that in mid-December on the second day when it closed below its upper Bollinger Band. It essentially led to a 2-month sideways move in the S&P 500. And then we also saw it in the first week of August. The second day it closed below that upper band. It led to essentially the low in the S&P 500.
Yeah.
So that's a near-term call. I don't think the VIX is really a signal about, you know, I don't look to the VIX as a signal or a leading indicator for the market. You know, it seems to be more of a coincident indicator.
Mm-hmm. I'll build on something Phil said. Look, job losses lead to diminished consumer confidence. Of course, it'll eventually affect consumer spending. But here, in terms of the canary in the coal mine, there might be something more granular that you hone in on for consumer spending. So in what is a sad and hopelessly skewed commentary of the US economy from a socio-economic perspective, almost 50% of all spending is done by the top quintile of households by income. And so if you see a pullback in some luxury consumer spending, which is where that cohort is now having second thoughts about all of this uncertainty playing out, maybe that's a leading indicator even ahead of any impact that jobs might have, because the low-end consumers sadly are just tapped out.
Yeah.
Their ability to spend and move the dial there is just, well, I mean, again, sadly limited.
That's the bigger picture when it comes to the wealth gap in the US. I mean, different conversation, but I feel like if the market can continue to digest this and is somewhat more orderly than it has been, it might not, you know, maybe it can come out on the other side. And again, you know, the point that I made earlier, you rip the Band-Aid off, let's get this all out there. The uncertainty is there. We know it's going to go away at some point versus, you know, 1.0 when it was, okay, let's talk about tariffs halfway in.
Yeah, just, you know, the possibility of reviving trade wars anytime in the next 3.5 years is there, right? And, you know, again, living with some level of risk premium around, you know, US supply is an issue. And I think that we have to get that into our heads. Unless there's a complete turn. You've seen President Trump talk about this as the best thing that's the United States has ever done in terms of reshaping the economy. The U.S. market, and I don't want to sound overly bearish, it's just easy, but we have a trade deficit, but we have a market cap surplus. We're worth twice as much as all of the other equities in the world, and we did this by finding supply in the cheapest place in the world and selling wherever demand was strongest. So globalization's helped American companies. And that's being set back some. It's not going to be erased, but it's being set back some.
Well, that's a good point that you make, because it's been, let's call it, a good 15, 16 years where we haven't experienced a prolonged environment of volatility. I mean, we had the blip during COVID. When you look on a longer term chart, but it really is a blip. But a policy change, a regime change, we really have not had a prolonged thing like that since the GFC.
So let's latch in on another fundamental driver you put on the table. Stock prices are all about corporate profits, and the US economy has found a way to just become far more profitable than it ever has been. So aggregate return on equity now exceeds 20%, never ever seen before. And the reason I kind of go in this direction is this short-term volatility, tariffs, policy uncertainty, is causing the multiple to compress because investors want a higher risk premium. If this is a headwind, the only tailwind that can offset this and overcome it is earnings growth. So earnings growth right now, with somewhat diminished expectations, is still expected to be 11.5%, 14% for next year. And so if the multiple compresses by 7, 8%, that's where we stop. But you can offset it with earnings growth of 14 or 15% and then throw in a bit of a dividend yield. And suddenly you have positive returns, not of the 25% variety, but modest, in line with historical averages, and suddenly things look like they're back to normal.
But the problem is that we did 2 years of above 20% gains in anticipation of those earnings estimates, which again for the first quarter look low, for the year look high. And some of these markets that, if you look at Brazil, I was just there, and expectations are horrible. Local confidence is low. 7 times earnings, 7% dividend yield, crushed last year in its currency. That is not long-term growth, right? I understand. But again, the expectations are low. And the problem has been expectations, around the world as we traveled. American exceptionalism should get an ever higher price. And that's a little bit of the problem when we're 2/3 of the market cap and half the earnings, even as exceptional as that is.
But a lot of that American exceptionalism and the earnings growth is coming from the artificial intelligence complex, which we tend to have a stranglehold on in terms of the companies doing it and the real revenues that are being spent on that.
Right.
So I think we have a really different structural equity market than a lot of the other countries in the world.
And so suddenly DeepSeek comes along, not necessarily to replace anything, but to show that there is a competitive challenge out there. Handsets, EVs, AI, it's possible that some of our companies don't get the full global pie because of competition.
May I just add to that? So DeepSeek now brings into question all the spending that US companies have done on AI infrastructure, right? This is where we could train, learn, get inferences. That is seriously at risk because they found a cheaper way to deliver models without that investment. But everyone else who is now looking to the infrastructure in place to now monetize it and build similar applications will benefit from the speed and the low cost that DeepSeek is.
Capacity constraints disappear, these sorts of things, at least directionally.
We have 30 seconds. Last question. But can't you make that argument? That's every industry. You're going to get scale at some point and more affordability as a competitive landscape evolves.
Yeah, they would. And so I keep going. So I completely understand that high valuations and earnings growth picking up outside the US make them intriguing this year. But over the very long term, that exceptionalism does belong here. We are home to the most innovative, profitable companies. I don't see that changing over the majority of the next decade.
All right, good outro. There we go. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.